Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is July 3rd of 2023. And I just want to wish everyone an absolutely fun, happy, and exciting July 4th weekend. Before we talk about the markets, I think it's important to remember those who sacrificed their lives and put their lives on the line for this country each and every day. This country could not be the greatest country of all time, and it is the greatest country of all time if it wasn't for the sacrifices that those before us and in present day make each and every day for us. So thank you for that. Now, as it relates to the overall market, we're starting to see the early signs that technology leadership is beginning to crack. If you've watched us for the last, really the last 2 months, we've been consistent and with high conviction that we are in one of the greatest tech bubbles of all time. And we are trying to position portfolios on the other side of that trade. So as that bubble bursts, where's that money going to flow toward? Well, to understand that, we need to understand the macroeconomic backdrop. And that's really the theme of this week is we're starting to see the early signs that as growth is starting to stall out in the economy, inflation, the deceleration of inflation is also plateauing at a much higher level. We think Q3 could be marked by the fact that inflation could bottom out at a much higher level than the market is currently predicting. What does that all mean? In simple words, stagflation. And so how do you position a portfolio for stagflation? So the three big things for this week, aside from the stagflation call, is as cracks are beginning to form in the tech bubble, what's the next step for you as an investor? Number two, what is the yield curve trying to tell us? We continue to see that deep inversion in the yield curve. It's getting worse by the week. We want to pay attention to it. It's nothing to scoff at. Number three, are commodity stocks showing the early signs of leadership? There's there's two economic backdrops that commodities tend to, from a historical standpoint, lead. One is during economic reacceleration, and number two is during stagflation. Excuse me. So, firstly, painting that picture of speculation. One of the things that concerns us about the market outside of energy, outside of gold, outside of certain areas of the consumer, is within that tech space, you're starting to see huge amounts of speculation. The AI news story counts just blowing out through the roof. Again, these are signs that are consistent with a bubble and hysteria. We've showed this chart for the last couple of weeks. It continues to go vertical. It's a common lesson on Wall Street that once a story reaches that front cover, you tend to want to sell it or buy it if it's a negative story. And what you're seeing here is the S&P 500 call volume going absolutely parabolic. This appears to be some sort of blow off top, specifically around growth and technology. That is what we're watching. That the call volume has been absolutely massive. And we don't think any of this ends particularly well for those particular areas of the market. Remember, we can't view the market as a monolith. We got to view it in certain segments. And so we're going to focus on the segments we don't like and the segments we like. Also, ladies and gentlemen, this is not normal. Apple and Microsoft as a percentage of the S&P 500, now 14%, okay? We put this picture, or Hedgeye, which is where we took this picture from, put the Titanic in the background. I think it's appropriate. Everyone's celebrating on the decks of the Titanic. I think that's a great analogy. Apple is now greater in market cap than the entire Russell 2000. To put this in the perspective, Apple is now larger than India, which is the most populous nation on earth of 1.4 billion people. It is larger than the UK. It is larger than France. It is larger than Brazil. It is larger than Italy, and it's larger than Canada. Yes, Apple is a great company, and it's massively profitable. Should it be worth more than these countries, though? I would argue absolutely not. If it doesn't look like it makes sense, it probably doesn't. Now, quietly lurking in the background of all this tech hysteria is the yield curve. The yield curve continues to deeply invert. What does that mean? Well, short-term rates are moving higher. Why? Because the Federal Reserve continues to battle inflation. Long-term rates are going down. Why? Well, because the market is sniffing out that growth is starting to slow. So if inflation is indeed plateauing at a higher low and growth is slowing, that gives us increased confidence that this yield curve inversion might be sniffing out stagflation. So if we're getting slower growth in the future and higher levels of sticky inflation, what does this mean for stocks? What does this mean for portfolio design? What does this mean for risk? These are very important questions. And I apologize about my voice. I am battling cold right now, so bear with me here. So the chart of the week, we think in reaction to this continued yield curve inversion and the cracks in technology, is the growth versus value chart. We can see here, growth versus value went parabolic in May, and it started to stall out. And it is no coincidence that our portfolios actually had a pretty good week. Why? Because we're positioned for the value trade, not for the growth trade. And so as this has started to stall out, we started to see reacceleration on the bottom end. So if we're right and money does flow into value, we believe that a lot of these value stocks, in particular commodities, could be really, really attractive at these levels. And we've seen that on the technicals as well. So when we look at the XOP, which is an energy ETF, again, broken out of this long-term resistance level. Now, this was actually Thursday. Friday, we had follow through on that breakout. So that's excellent to see. And that's, by the way, near 52-week lows for the price of oil. What happens if oil actually starts to break out and hits 80? We think that there's probably strong acceleration on this chart. I would also note that within energy, the drillers and the servicers have actually been leading the rally, which is important because they have a much higher beta. They have much more, they have a higher earnings sensitivity to the price of oil than the actual E&P producers. So the fact that they're leading the recovery and are actually closer to 52-week highs than their E&P brethren, I think is a good sign from a technical perspective. And we know that energy is well positioned from an earnings perspective because when we look at the sector weight, it's only 4.6% of the S&P 500, but its earnings weight is 12.7% versus tech, which has an earnings weight of 19.7% or 19.2%, while the sector weight is 26.1%. We think those things flip around, and we want to be positioned in energy. Now, the other thing we would note is it is hard for markets to go truly into a new bull market when unemployment is already very low. So when we look historically and we said, what are forward returns for the market at the worst unemployment levels versus the best unemployment levels? It's when unemployment is actually really, really high that you want to invest anywhere in the market. Just throw darts anywhere and you'll make money. It's when unemployment is really low where it's harder to make money. Why? Because it means you're probably closer to the end of the cycle than the beginning of the cycle. Again, this is an important factor to consider when we're looking at portfolio design, is right now we're in these boxes here, not in these boxes over here. So with unemployment in the fours, how much lower can you go is basically the question. The other factor we are paying attention to is the banks continue to look weak. Despite this big rally you've seen in the market, despite the rally you've seen in technology, and now even some of the rally you've seen in energy and other commodity stocks, the banks just are not participating. I mean, Bank of America is near a 52-week low. Goldman Sachs is close to a 52-week low, close to breaking technical support. So again, something's up there in that sector. We are not exposed to that area of the market right now, nor do we want to be. The other thing I would note is year to date. So when we look at the factors, the quantitative factors that are leading the market rally, the two biggest factors are high beta up 21 and low yield up 20.6. In other words, this is speculation and volatility. This is something we want to be very careful at. Look at this. The low beta is actually down 4% for the year. So in other words, defensive stocks or stocks of higher quality are down, and high yield is up only in the single digits. So you're not being paid for quality, you're being paid for risk. And that's, again, we want to be really, really careful when the market is showing this signs of behavior. On the corporate credit side, on the other hand, we're starting to see corporate spreads compress a little bit, which is good. And this is a completely different segment of our overall portfolios that we don't talk enough about. But on the bond side, we're seeing lots of great opportunities. So interest rates are at 52-week highs in terms of policy rates. So we're able to build really attractive corporate bond and government bond portfolios at attractive interest rates. And what we've also seen is the fact, despite the fact that, whether it's names like Bank of America or, say Goldman Sachs or Ford or Carnival Cruise offer paper in the 6, 7, 8, 9% range, those spreads are actually compressing. So in other words, the corporate credit quality is improving. So overall, this gives us a moment to buy quality paper, and we can lock in a lot of these high rates for many years down in the future. So lots of good opportunities in the bond market as we see it, especially for those clients that are looking for some elevated income levels. So what is the bottom line here, ladies and gentlemen? Another week has passed where we think cracks are continuing to appear in technology. I think that's very, very important. And where value stocks seem to be making a stand here. And I think that's really an intriguing observation. So 3 big things. If you own technology, please sell some. We really have high conviction here that things are out of hand. We're in a dangerous bubble there. Number 2, the yield curve continues to invert. It's slower growth ahead. It's slower growth combined with higher inflation ahead. We want that. That's going to be, I think, a big theme of Q3. And lastly, inflation may be bottoming, as we just said, and stagflation tends to be good for commodities. That's what we got for everyone this week. Happy Independence Day, happy July 4th, and we're certainly proud to be living in the greatest country of all time. Please reach out if you have any questions, 888-543-3776. Thank you again, and have a great day.